This channel is for educational purposes only. You and you alone are responsible for your investment decisions. Today I'm going to cover an actual options trade that I made earlier this week, selling a cash secured put. Before I go into the specifics of that trade, let me explain what options investing has allowed our family to do. We were able to pay off a home in less than 8 years, in full. By choice, my wife was able to retire in her mid-30s. For the most part, I retired in my 40s. It funds our current lifestyle, include bills, vacations, and future investments. The intent is not to brag, but rather to highlight the power of options trading. Despite never earning more than $80,000 annually from our W-2 jobs as a family, we've attained financial freedom. Often perceived as overly complex or excessively risky, some are simply hesitant to invest the modest amount of time required to grasp the concept of options trading. If you've mastered 5th grade math, possess the capability to listen, learn, and read, you already possess the foundational skills to explore options trading. Periodically, I'll suggest reading material aimed at enhancing your skills. Your mind is your most valuable asset when it comes to generating income, and investing in its development can yield perpetual returns in lifetime earnings. This recently published book, available for less than $15, is a prime example of such material. I'm going to cover how I use options to enrich our family's income, but if you want detailed specifics, I'll link the book in the description. I'm going to pull up what the internet says selling a cash secure put is. Go ahead, pause this, read it, and then I'll explain how I do this in practice. Here we go. Essentially, I took the Tesla out, did a few Ubers, and made $150. I took that cash and deposited it into a brokerage account approved for basic options trading. Because one options contract equals 100 shares, I had to find a stock trading around $1.50 a share. Now I had to search hard because I normally don't trade stocks this small, but Tilray came to mind. I remember when it was trading much higher, and I'm looking for something that's growing, that I feel won't go bankrupt, that I would be comfortable owning 100 shares of. A quick shout out to my childhood friend Matt for reminding me that this stock even exists. So let's take a look at the actual trade. On February 20th, I sold one put that expires on April 19th of 2024. The strike price is $1.50, and I received 15 cents per share. After the 45-cent commission, immediately deposited into my account was $14.54. This is normally where people get lost, so I recommend pausing this, reading this, and then listening to what I have to say. There's 3 parts to an option contract, so let's take a look at each piece. Number 1, the expiration date. In this case, the option expires on April 19th, 2024. Either one of really 3 things will happen. Either it's this stock, Tilray, is trading below $1.50 a share, and then I will be obligated to buy 100 shares for $150, no matter how low this stock goes, even if it goes bankrupt. Another thing that can happen, and it honestly happens the majority of the time, on expiration date, the stock that I've selected is trading above the strike price. So in this case, above $1.50 a share. In that case, the contract expires worthless, and I get to keep the premium that I got originally when I wrote it. My $150 that was tied up to cover this option contract becomes available, and I could write another option contract. And then when that expires, I could write another option contract. The final outcome, anytime between now and expiration date, if that option drops below $1.50 a share, it could be executed. It's because we're trading American style options. If it were a European style option, then it could only be exercised at expiration. But again, the cash is in the account. It's a cash secured option. So the money is available, and then I would own 100 shares of said asset. Let's take a look at number 2, the strike price. I chose on the options table $1.50 a share for the strike. Now, I could have chose something lower, but the odds of hitting that would have been lower, and the premium that I would have got would have also been lower. Another way to actually get higher premiums is to extend out time. If I had selected instead of April, maybe July, then instead of 15 cents, I might have got 25 cents. Why? Because there's more risk to me that during that period of time that this option will go in the money and I will have to buy the 100 shares. Thinking, man, whoop-de-doo, you made $14.50 some odd cents. Think of it in a percentage basis. I'm literally making almost 10% in less than 2 months. And if I could do that over and over and over again with this particular trade, I would make over 50% a year. One final thought. What if you did not have to wait till expiration date to close this option out? I sold an option against NVIDIA a while back. It has 56 days now until it expires. At the time, I got $10.44 a share for 100 shares, so $1,045. And now it's currently trading at $1.46 to $1.62. That's the big bid-ask spread, which I haven't talked about, but that's the buyer and the seller. So somewhere in the middle there is what this could be closed out with. So essentially, if I set a limit order and said, well, I want to buy this back for, say, $1.50 a share, I make $10.44 a share minus $1.50, which is $894 as a short-term capital gain. At that point, it's like the option never existed and your cash that's securing that trade is released. So how is that even possible? One is because of time decay. That is the reduction of an option's premium or price over time until the point at which it expires worthless. The second reason is the underlying asset, in this case NVIDIA, has gone up in value. So there's less risk that this trade will actually execute in the money and that I'll be forced to buy 100 shares of NVIDIA. I've had options that I can literally buy back days later because the underlying asset, the stock, bounced in value. And that caused the option premiums to go down, and I was able to basically sell them to open and then buy them to close and bank the difference. If for any reason you're thoroughly lost, I encourage you to check out the book in the description or ask a question in the comments. I'll get back with you. I'll answer those to the best of my knowledge. And I got to wrap this up. The market's going to open soon, and we get to watch the NVIDIA rocket ship take flight.